Hi, and welcome to the Morgans Edward Street weekly wrap for the Friday the 14th of July. Things are starting to settle down a little as we head into the new financial year. Apart from the Mighty Maroons wrapping up yet another series win against New South Wales, the US markets have also been winning by roaring ahead on the back of yelling comments. Over the course of this update, we'll be referring to particular stocks. Please remember that our comments, as always, are general in nature, and please speak to your Edward Street advisor if you wish to know if these recommendations suit your personal objectives and needs. To get a more detailed rundown of the week, I'll pass over to Matthew Gordon for his summary. Matt?
Thanks, Brad. Our market in general has been a bit like watching a tennis match this week, with a couple of good up days and a decent down day on Wednesday. Overall, our market is trading slightly up for the week, and we are likely to see a continuation of this sideways movement until the market finds some direction, which may well come in a couple of weeks' time when the reporting season begins. This week, the US market, including the Nasdaq, have been stronger, and commodities have been a touch firmer as well, with gold, copper, iron ore and oil having a slightly better week. Locally, we are seeing a lot of smaller unloved stocks finding their feet and starting to rise, which should be a good sign for the overall market as well. Stocks in the fast lane this week include BHP, which has benefited from the commodity prices I mentioned earlier, and is now up over 7% so far this financial year. Adairs and APE Eagers have also come through some much needed upgrades and moved higher as a result. And smaller financial stock Pioneer Credit upgraded last night and also gave guidance for a massive 50% increase in net profit for 2018. It may be a good one to put in your watch list. Its code is PNC. In the slow lane this week, we have Coca-Cola still battling after losing the Domino's contract to Pepsi, and Woolworths refusing to stock their new zero sugar Coke product. Another in the retail space, Retail Food Group, is considerably lower after attracting some shorting activity after a recent update and new accounting treatment for leasing starting to weigh on investors' minds. Looking forward, we are still keeping a close eye on US bond yields, which were a touch weaker after Janet Yellen's dovish comments, and the US dollar, which has been in slow decline since the start of the calendar year. As a result, our dollar trades as high as 77.5 cents this week, and the Canadian dollar jumped over 78 cents against the US dollar after the Bank of Canada raised rates for the first time in 7 years. For anyone travelling to the US, it may be a good time to pick up a few US dollars, given the Aussie is approaching yearly highs. Cheers, Brad.
Now, as always, this week we'll focus on a stock, and this week we'll hand over to Cameron Moll to talk about BT. Cameron?
Thanks, Brad. During the week, I've been buying BT Investment Management for clients, ticker code BTT. BT is an Australian company engaged in the provisions of investment management services and operates in major global markets, including the United States, the UK, Asia, Europe, and of course Australia. I remain a happy buyer of the stock at $11 for three main reasons. Firstly, we've continued to see strong funds flow into the business, which was evident this week with a third quarter update from their funds under management. This figure came in at 94.4 billion Australian dollars. BT's FUM has increased 3.5% over the quarter as the demand for European exposure picks up. I believe the recovery story in Europe is likely to continue, and with the US expecting to see interest rate rises over the near term, this should result in funds outflow from US equity markets, with European equities the likely beneficiary. The second reason is at $11, this stock is trading at approximately 17.2 times PE on FY18 figures. This is lower than the 3-year PE average of 18.3 times, which is also surprising given the stronger inflow of funds that we've seen. The recent pullback in the share price from the mid-$12 range has largely resulted from an analyst downgrade, from UBS pointing to lower performance fees. Whilst I acknowledge performance fees will be lower, I note that these fees only represent 12% of the overall fee revenue generated by BT on first half figures. As such, I believe the current sell-off has been overdone, and this has created the buying opportunity. In agreement with my view is Macquarie Bank, which yesterday upgraded their views on the stock, moving it to an outperform from neutral. And my third point is the added liquidity in the stock and the change of the register, with Westpac recently selling off a significant holding from 30% ownership of BT to now only owning 11%. The diminishing threat for BT, knowing Westpac are looking for the exits, should give greater comfort to investors moving forward. Morgans currently have a hold recommendation and a $12.54 price target.
In terms of corporate actions and IPO of note this week, we're a bit light on the ground. Of course, Convenience Retail REIT is due in at the end of next week, so please make sure you have your paperwork in by then. Well, that wraps up another edition. Please feel free to share this video with your colleagues or friends and hop onto Facebook and visit our Morgans Edward Street stockbroking page. Finally, please speak to your advisor about any of the stocks we've mentioned today, and we'll see you again next week.